The dollar is going to zero. Now, I'm not saying that to scare you, I'm saying it because it's a fact. Charlie Munger, who is Warren Buffett's longtime business partner and has himself outperformed the market by over 2,000% since 1986 in his daily journal portfolio, says the dollar will eventually trend towards zero.
The safe assumption for an investor is that over the next 100 years, the currency is going to zero.
And Ray Dalio, another famous investor who correctly predicted the last financial crisis that kickstarted the Great Recession, says the dollar is done for. So hey everyone, and welcome to FinTech. And in this video, I'm going to break down exactly what could destabilize the US dollar and cause it to lose its status as the reserve currency of the world, as well as why the dollar is ultimately headed for zero. And I'll lastly talk about how you could protect yourself and your savings from going to zero too. So to start, we need a good understanding of where the dollar's value actually comes from. After all, the Federal Reserve printed $4.5 trillion during the pandemic. And understanding how that's even possible is the key to understanding the massive effect it's going to have on the value of a dollar. So M2 is the measurement of money in the economy. So things like cash, checking accounts, money that's sitting in your brokerage in a money market account. And that type of money has been absolutely flooding into the economy recently. We can see how the M2 money supply has increased exponentially over the past 60 years. But then in 2020, we can see the supply pretty much shoot straight up all of the sudden. This is due to the policy of quantitative easing by the Federal Reserve, where the central bank buys securities in order to push more money out to consumers and businesses. In the depths of the pandemic, this helped stimulate the economy and protect a lot of businesses. But today, we're starting to feel the unintended effects of that action, which could massively affect the value of a dollar going forward. But before we get to what's happening to the dollar today, let's take a look at the history of powerful so-called reserve currencies like the US dollar to see what that can tell us about the dollar's future. And this is really where Charlie Munger's warning comes into play. See, looking at data as far back as the 1600s, we can see that the average reserve currency only lasts around 100 years, with the British pound sterling preceding the US dollar as the reserve currency of the world, and before that we have France, the Netherlands, Spain, and Portugal, all lasting around 100 years, and all that eventually giving way to the next reserve currency. Meanwhile, the average fiat currency only lasts around 30 years. But how long has the US dollar been the world's reserve currency, and are we nearing the end of the dollar's reign? Well, the US dollar has existed in some form for over 200 years, but it's undergone several major changes between then and now. In fact, if we look at this chart of the value of a US dollar over time, we can see how it actually fluctuates up and down for most of its history before the 1900s. But we can also see three key inflection points in this chart. One in 1913, one in 1933, and one around the 1970s that set the dollar on the path towards zero at an accelerating rate. Up until 1913, the dollar's value was pegged to the price of gold. If you wanted to, you could go to your local bank and exchange your dollar bills for gold bullion. But after several bank runs in the early 1900s where people tried to pull all their money out in the form of gold, in 1913, the Federal Reserve was created. The goal of the Fed was to help ensure the flow of money and credit throughout the United States and hopefully avoid future bank runs where people would panic and pull their money out of local banks. Now, it wasn't totally effective at first, as we soon saw the Great Depression hit along with a whole nother slew of bank runs. So in 1933, President Franklin D. Roosevelt declared that not only did banks no longer need to pay out gold for dollars when asked, they were expressly forbidden from doing so. This meant that banks no longer needed to keep gold in their vaults, and all that gold was instead maintained by the US government. And we can see how the value of the dollar started to fall following this change. 40 years passed, and then in 1971, President Nixon announced that the US was leaving the gold standard completely, meaning there was nothing tangible backing the US dollar anymore. The only thing that made a US dollar worth anything was that other people believed it was worth something, and the backing of the Federal Reserve. It was at this point that the US entered a period of non-stop inflation that has continued for the last half a century, which you can see on this chart as the inflation rocket shipped up for over time. It's also why, relative to 200 years ago, the dollar is already basically worthless compared to where it used to be. But okay, we get that historically inflation is devaluing the dollar, but it's been pretty steady for most of the US's history. But something has changed that has billionaires like the famous investor Ray Dalio extremely worried. Ray Dalio has this famous book called The Changing World Order: Why Nations Succeed and Fail, which shows a repeated cycle of money, greed, and destruction every major civilization in history has followed. And we're going to dive into exactly where he thinks the United States is on this cycle. So there are essentially 6 stages in how a civilization stores its wealth, and no, one of them is not keeping it under your mattress. In stage 1, there's essentially no debt, and everything is paid in hard money, something with inherent value. This might be buying services using food, or even something like gold, which is pretty much universally recognized as a store of value. This is a very stable state, since no one can argue when you give them a bag of grain that it isn't inherently worth something, because worst case, if you can't trade it, you could always eat it for food. Stage 2 is claims on hard money. So this could be like an IOU written on a piece of paper, or it could be paper money like the dollar that is backed by gold. This makes transactions way more efficient. Imagine if Meet Kevin had to get paid his $3 million per month in gold. That's like 100 pounds of gold he'd be lugging into a studio every month. And wouldn't that just be horrible? So paper money just makes everything easier to deal with. Stage 3 in Dalio's cycle is increased debt, where people start to borrow paper claims more and more. This is peak greed, when claims on debt outpace the total money in the system. So I might lend out $1 3 or 4 times, and pretty soon the value of the debt is 4 times the value of the original dollar that we started with. In stage 4, the debt defaults and money starts to devalue, similar to the bank runs in the 1930s. Stage 5 is where we finally get to where we are today, fiat money. Ever since we left the gold standard, there is no longer any tie between the currency and hard money like gold. This is also why the Federal Reserve was able to print over $4 trillion of new money basically out of thin air during the pandemic. And while that did help stabilize struggling businesses and provide some support to consumers, a lot of that value ended up flowing into asset values. Everybody now had excess money, so they started investing it. And pretty soon we set new records in the stock market, in housing, and in crypto. To give some perspective on just how much money was created, if you stacked 4 trillion $1 bills on top of each other, you would have a stack around 675,000 miles high. That's nearly 3 times the distance to the moon. So it's no wonder we're seeing many claims that we are in an asset bubble, and also why we're seeing record high inflation. With the CPI, or Consumer Price Index, reporting prices are up 6.2% since a year ago. Which leads us to the final stage in Ray Dalio's cycle, flight back to hard money. With the currency devaluing rapidly, everyone abandoned ship into whatever valuable assets they can get. Gold, other currencies, or even other assets in other countries. Now, we haven't hit this stage yet in the US. You would know it if we did. But we have seen billionaires like Charlie Munger move substantial amounts of his capital into Chinese companies, saying they are currently being underestimated by the market. We also see other potential reserve currencies popping up, like the euro or the Chinese yen, and while these today make up just a tiny percentage of the reserve currency of the world, they are growing, which leads some to think that the US might already be on the right side of this chart, while China might be on the left. But like I said, we're not in the stage yet where the US dollar will be replaced. The yen is still not independent enough from the Chinese government to make an effective reserve currency, and the euro is just really hard to get debt on since it's tied up in the bureaucracies of each individual nation of the European Union. For the foreseeable future, the dollar is still the best place for foreign investment. But Charlie Munger did say that over the next 100 years, the US dollar is going to zero, and he's not just talking about the dollar slowly devaluing over time here.
Inflation is a very serious subject. You can argue it's the way democracies die. When democracy dies in Latin America, inflation is a big part of it.
And even looking all the way back to ancient times, Munger argues inflation was one of the major causes of the collapse of the Roman Empire.
They inflated the currency steadily for hundreds of years, and eventually the whole Roman Empire collapsed.
To see what Munger's talking about, and to tie this back to Ray Dalio's life cycle of nations, we can look at the famous recent example of Zimbabwe. After Zimbabwe gained independence in the 1980s, the country issued bills between $2 and $20 denominations. But between 2007 and 2009, the country quickly entered a period of high inflation, which got so bad that they started issuing $100 trillion bills by the end of it. You could go to work in the morning, and by the end of the day, your wages were worth half what they were in the morning, simply due to inflation. Here's a photo of a man buying 3 eggs with a $100 billion Zimbabwean note. Now, eventually, the population lost faith in the currency completely and moved to using foreign currencies instead to run their economy. In Latin America, Venezuela recently experienced hyperinflation, with prices rising 684% in 2021, as the government responded to dropping oil prices by simply printing more and more money to keep the government running. There are countless other examples we could go through. Germany after World War I, Greece after World War II, Yugoslavia in the 1990s. The point is, there have been 750 currencies since 1700. 20% of those have survived, and of those, 100% have been devalued. Eventually, all fiat currencies will fall to zero. It's a question of when, not if. But now we get to move on to the best part, where I talk about what you can do to protect yourself from the devaluing dollar. And it's not grabbing your 5 free stocks from Moomoo using the link in the description, though that couldn't hurt. So the first way to protect yourself is the most obvious. You can diversify away from pure dollars and into assets like stocks and real estate. Now, stocks in US companies are likely tied to the value of the US dollar, but multinational corporations, even those based in the US, may be resilient enough to withstand inflation in the US dollar. You can also put money into real estate, which can act as an effective hedge against inflation, since prices tend to rise at least at the rate of inflation. You could also diversify your currency into assets like gold or foreign currencies, but I'm actually not a huge fan of that. Both stocks and bonds have consistently outperformed gold over a long time horizon, and while it does act as a good hedge during high inflation, it doesn't create new value the rest of the time like you would with stocks or a rental property. A better option might be something like Bitcoin, which does have pretty strong ties to the dollar today since the dollar is the reserve currency of the world, but it might do well as a very long hedge against inflation. The drawback here is it's so volatile that in the short term, you don't really know where the price is going to go next. So this certainly isn't a total solution for all of your money to go into. You could also make like Charlie Munger and diversify internationally, focusing on companies based in Europe or China who won't be as affected by the US dollar. But this will tend to expose you to more downside risk, as these countries can't manipulate their currency to stabilize their economies quite like the US can. The other option is to do what billionaires do all the time. You can borrow money. Now, that might sound a little weird, so let me explain. Currently, interest rates are rising from historically low levels, but not nearly as fast as inflation, and we can use this difference in rates to our advantage. As an example, I currently have a mortgage on my house, which I got a pretty low rate on during the pandemic. Let's just say around 3% per year. Inflation in the past year has increased by 6.2%. This means that the dollar has devalued faster than the interest rate on my loan. So I effectively made 6.2% minus 3%, or 3.2% in value by holding my loan. Basically, if I can borrow at a lower interest rate than inflation, or even borrow at a lower interest rate than I can make in investments like stocks or real estate, I can make money off the debt. Now, there is risk in doing so, but if you're careful, this is a way that you can make money off of other people's money. But here's where it starts to get really weird. I can then take out more debt on the gains that I made. So maybe the value of my house increases 10% last year. So my $300,000 house is now worth $330,000. Rather than selling and keeping the extra $30,000 in cash and paying taxes on that, I could simply take out debt against the entire asset and then use that money to invest somewhere else, which means I don't pay taxes on the gain, since in the government eyes, I don't make money until I sell. In fact, the government will let me write off the debt payments as a loss, even though inflation is higher than my interest rate. Now again, debt can be dangerous and you have to be responsible, but this is why during periods of high inflation, people who hold their savings lose money, while people who borrow against assets make money. Of course, people with assets is just code word for rich people. So while inflation might be hurting your wallet, these same billionaires who are issuing these warnings might be making more money than ever. It's almost like once you have money, it's a lot harder to lose, which is really interesting. But we all have to start somewhere, and you may as well start by grabbing your 5 free stocks from Moomoo worth up to $3,500 when you meet the terms that you can read using the link in the description. Don't forget to like and subscribe, and I'll see you next time.